that's where the overlay world started to come to light. And the loan officer just tells them like it's too low. They don't explain whether it's the rule book or the overlay, and shame on the industry for not doing that.
So it's not only is it possible, it's probable that some loan officers don't even know the difference between their company's overlays and the actual rule book.
That is highly possible, and I think it happens more than the industry realizes, because let's be a loan officer that here's this customer and they got to tell them no. And I'm not saying loan officers are consciously doing this. They just don't know they're doing it, but they're saying no because they don't want to tell them, hey, oh yeah, I'm sorry, Mr. Borrower, I can't help you with the loan. But if you call somebody else, they probably can. Nobody wants to do that.
Right.
I mean, I've learned that has benefit if you actually tell the borrower when you tell them no, it's the actual rule, or if it's one of your overlays. And there's some value in that.
Okay. Let me ask you this question. Why do some lenders have overlays?
It's risks, it's tolerance for risk is how I explain it. So I know we're going to talk about some specific ones here a little bit, but imagine, a borrower has to repay their mortgage. That's why we give them one. And some people are willing to jump off of a diving board that's 3 feet tall, and some people are willing to jump off a diving board that's 10 feet tall. They have different personal fear factor in them of how high they will jump into a pool. It's kind of like that for mortgages. Lenders have different tolerances of risk they will take based on historical data that they probably have for performance of a loan being paid back so they don't have to go through foreclosure. And I think the other part they've got these things exist is when they want the VA or the FHA to ultimately insure the loan, that's the ultimate goal real estate agents need to understand is it's not that people don't want buyers to have loans. It's the insurance policy that every lender wants to have. Well, if underwritten the loan's closed, there's more audits that happen after the loan closes. And I don't know if real estate agents all know that there's ultimately the last audit is let's just use the FHA again. The FHA looks at the loan from a lender and makes sure they followed the rule book. If they didn't, the FHA is not going to insure it. Doesn't affect the homeowner at all, but it affects the lender. So I think lenders put overlays in because if they have the overlay, but they messed it up and they're off by a little bit, well, they still got a cushion that the FHA will still insure it. I think that's one of their reasons.
I would agree. Over the years, when loans go in default, when a HUD loan or FHA, go back to 2008 during the Great Recession, a lot of loans went into default foreclosure. The HUD can actually go back to the lender years later. So a lot of realtors may not understand this, but they can go back to the lender and say, hey, you approved this loan 3 years ago. We audited the file because the file went to foreclosure. You made these mistakes. Now you have to buy the loan back from us. And lenders lost tons of money during the Great Recession because of sloppy underwriting. And years later, they came back and said, hey, I know this loan closed in 2004 and it's 2008, but it's in foreclosure and you didn't follow this, that, or the other. And now write us a check for $280,000. And that put a lot of lenders in a bad position, and hence it's spiraled out of control. And there's bankruptcies like crazy from mortgage companies.